Hello and welcome back to a new educational video. Last time we talked about trend trading and we made a pretty nice strategy for it. Check the link in the description if you haven't watched it yet. But markets don't trend all the time. In fact, a large portion of the time, price moves sideways. And this is where most traders struggle, because they try to force trend strategies in a ranging market. So instead of making money, they get chopped up. In this video, I'll show you how to identify a range, where liquidity builds inside it, how to trade mean reversion setups, how to avoid breakout traps, and how ranges lead to explosive moves. Let's get into it. Before you trade a range, you need to recognize the environment correctly, because the way you trade a range is completely different from how you trade a trend. A range is simply a market moving between two clear boundaries. Resistance at the top, support at the bottom. But more importantly, a range represents a lack of directional conviction. When the market is ranging, it's not random. It's actually a phase where the market is deciding what to do next. Think of it like this. After a strong move, the market pauses. During this pause, buyers are taking profits, sellers are trying to push price down, and new positions are being built on both sides. This creates balance. So what a range actually looks like. It has equal highs, sellers consistently defend the same area, equal lows, buyers are consistently defending the same area, no clean higher highs or lower lows, meaning no trend structure, overlapping candles, choppy, indecisive price action, and frequent rejections at both ends. Price keeps getting pushed back into the range. Instead of clean moves, you'll see price bounce back and forth. This tells you one important thing. The market is not trending, it's rotating around value. Neither buyers nor sellers are in control, and that's why trend strategies usually fail here. Why this matters for trading? If you mistake a range for a trend, you likely chase breakouts that fail and get caught in reversals. But if you correctly identify a range, you can shift your mindset to buying low at support, selling high at resistance, and expecting reversals instead of continuation. So the first rule of range trading is if there is no clear trend, assume a range. Now, here's where it gets interesting. Ranges are full of liquidity. At the top of the range, we have buy-side liquidity from stops from short sellers, and at the bottom of the range, we have sell-side liquidity, stops from long traders. And the market loves liquidity. So what usually happens? Price doesn't just respect highs and lows, it often goes slightly beyond them. These moves are called liquidity sweeps. For example, price breaks above resistance, triggers stops, and then reverses down. And at support, price breaks below support, triggers stops, and then reverses up. Why this happens? Think about where most traders place their stops. Short traders place their stops above resistance, and long traders place their stops below support. This creates a pool of liquidity at the edges of the range. So what does the market do? It moves into those areas to trigger stop losses, fill large orders, and trap breakout traders. Then once liquidity is taken, price often reverses back into the range. So rule number 2 is expect fakeouts at the edges of the range. Now, let's see how we trade mean reversion setups. In a trending market, you trade continuation, but in a range, you trade reversion. That means price tends to move back toward the middle of the range. When price reaches the extremes, it is considered expensive at the top and cheap at the bottom. Why? Because most trading activity usually happens closer to the middle. That's where the market finds fair value. So when price moves too far away from that value, it often gets pulled back. Think of it like a magnet. The middle of the range acts like a magnet. Price moves away, becomes stretched, then rotates back. This is the core idea behind mean reversion. Now, this is where your edge becomes much stronger. When you apply a volume profile to the range, you'll see the point of control near the middle, high volume nodes, areas of acceptance, and low volume nodes, fast moving zones. This tells you the point of control, which is fair value, the zone where price wants to return, and the range highs and lows with low volume edges, which are areas of rejection. So instead of guessing, you can clearly see where price is likely to revert to and where it is likely to reject from. The ideal setup for mean reversion trading is at range highs, where we have liquidity sweeps above resistance, acceptance back inside the range, and low volume area nodes. In this zone here, we are looking for shorts targeting point of control and EQ of the range. And at range lows, same idea. Liquidity sweep below support, strong reaction upward, low volume areas at the edge, and we look for longs targeting point of control and middle of the range. The best trades in a range happen when price is at extremes, liquidity has been taken, and price starts rotating back toward high volume areas. So our rule number 3 is trade from the edges. Now let's talk about breakout traps. This is where most traders lose. They see price breaking out of the range and immediately jump in, expecting a strong move. But here's the truth. Most breakouts in ranges fail. Why? Because the market doesn't move just to break levels. It moves to find liquidity. And where is liquidity? Above range highs and below range lows. So what happens is price breaks out, triggers breakout traders, hits stop losses, and creates liquidity. Then, once that liquidity is taken, price often reverses back into the range. How a breakout trap usually looks like. It has a strong move outside the range, looks like a clean breakout, but quickly loses momentum, and prices closes back inside the range. That last part is key. If price cannot hold outside the range, the breakout is weak. So instead of entering immediately, you wait for a rejection candle outside the range, a return back inside, a failure to continue higher or lower, and a shift in momentum. This turns the breakout into a high probability reversal setup. A true breakout is very different from a trap. It usually has strong impulsive move, clear momentum, volume expansion, real participation, clean breakup structure, and most importantly, price holds outside the range. And our rule number 4 is don't trade the breakout. Trade the reaction after the breakout. Wait to see, does price accept outside the range or reject it? That decision tells you everything. Now let's see a few examples. I have here a few images for you. So we have a clear range and we have a liquidity sweep here. Price takes liquidity from the previous high, closes back inside the range, and then rotates back all the way to range lows. But in case of a fake out, we have this example here. Price breaks above range highs, spends some time above it, but then closes back inside the range. When this happens, it gives us a market structure break. This tells us that the structure has changed. So instead of chasing candles, we wait for a confirmation, which is a retest in a high confluence zone. And for that, we use the tools that we learned before. We use a Fibonacci from the high to the low that break the market structure, and we also can add an anchor VWAP from the high, and it gives us the same area around golden pocket. So we wait for price to come and retest this zone here, and from here we can enter short. Of course, this is a 4-hour chart. If you want to get a more tight risk reward, you can go on a lower time frame like the 30 minutes and find a better entry with a lower time frame market structure break, and you can have your stop loss above the high if you are treating this trade as a scalp or an intraday. But if you're looking for it as a swing trade, I recommend you stick to a higher time frame because you don't need a super tight risk reward, and this way you eliminate the risk of being stopped out a few times before you catch the final move. Now let's see what a breakout looks like. So here we have price breaking out of the range. And as we said, we don't chase candles, we wait for a confirmation. Price goes up again, retests perfectly range lows, and from here rejects. Going on a lower time frame, you look for a market structure break to confirm your entry. And this is how you get your entry, your stop at the swing high, and you're targeting lower prices. But ranges don't last forever. They are just one phase in the market cycle. The market constantly moves between balance and imbalance. The typical cycle looks like this. range, liquidity build, and expansion. What this means? While price is stuck in a range, something important is happening. Liquidity is building on both sides. Above the highs, we have buy-side liquidity, and below the lows, sell-side liquidity. Every time price taps the highs or the lows, more stop losses accumulate, more breakout traders get involved. So the longer the price stays in the range, the more liquidity builds, the more pressure builds, and the more significant the eventually breakout move will be. Why expansion happens? At some point, the market will take a large amount of liquidity, create imbalance, and move strongly in one direction. This is the expansion phase, the start of a new trend. But your job as a trader is not to predict which side will break, because inside the range, both sides are valid targets. Instead, you wait for the market to show its hand. Now, let's see how to combine all of this with what we learned so far. Inside the range, you trade mean reversions. After the breakout, you switch to trend-following strategies. This is how everything connects in your system. So, rule number 5 is trade the range until the market proves it's trending. Don't assume the breakout, wait for confirmation. And the final point of this educational video, common mistakes. First one is treating a range like a trend. This leads to bad breakout trades. Second one is entering in the middle of the range, which gives you worst risk to reward. Third one is ignoring liquidity sweeps, and this way you are getting trapped at extremes. The next one is forcing trades when price is messy and you have no clear edge. And the last one, trying to predict breakouts instead of reacting. You get early entries but unnecessary losses. So ranges are where patience pays the most. If you understand where liquidity sits, how price behaves at the edges, and when the market is in balance, you stop getting trapped and start trading with intention. In the next video, we'll dive into chart patterns like triangles, flags, and head and shoulders, and I'll show you how to use them in real trading. I'll see you in the next one. Bye bye!